Hi there, welcome back to Alpha Market Meridian. I am Eric. Have you ever stopped to consider this? In a single 24-hour window, oil explodes 8%, the Federal Reserve fractures into historic descent, the Japanese yen collapses 3% against the dollar and then violently screams back, and the world's largest sovereign wealth funds are quietly reshuffling their asset allocations. Now, inside that entire hurricane, the DIF line remains positive for now, the momentum bleed is undeniable. Drop down to the 4-hour chart, and the picture sharpens. Bitcoin is oscillating around its 5-period and 10-period moving averages on this timeframe, but it is being firmly rejected by the 30-period moving average at $77,178. The MACD on the 4-hour chart is printing a continuous stream of bearish momentum, and the RSI sits at 44, confirming that the sellers hold the steering wheel, though the pace of the decline has softened slightly. Overall, Bitcoin is carving out a wide, high-level consolidation range between roughly $75,000 and $78,000. Data from Glassnode reveals that short-term holders have been taking profits aggressively inside the $78,000 to $79,000 zone, reinforcing this band as a zone of genuine, heavy market resistance. Additionally, over the past week, Bitcoin exchange-traded funds have seen persistent capital outflows, including a single-day net outflow of $137.8 million. On the downside, immediate support is located at $75,500, followed by the psychological floor at $75,000. Should $75,000 be taken out with conviction, the next test will be the dense prior trading zone between $74,000 and $74,500. Now pivot to the US equity market. Last night, the three major indices closed in mixed fashion. The Dow Jones Industrial Average shed 280 points, a drop of 0.57%, closing at 48,800 at 7,135. The Nasdaq Composite eked out a gain of 9.44 points, a 0.04% rise, to settle at 24,673. The after-hours session, however, has been anything but quiet. Major technology earnings are pouring in. Meta is getting crushed in the pre-market, down over 9%. Qualcomm is surging nearly 10% on its results. Intel is skyrocketing over 12%. The market's attention is laser-focused on the earnings surprises from these mega-cap weight names. Now I need to reveal the invisible thread that is binding Bitcoin and the Nasdaq together in a way that is about to matter immensely for your trading. Over the past 12 months, the rolling 30-day correlation between Bitcoin and the Nasdaq 100 has persistently hovered between 0.6 and 0.8. That number is vastly higher than Bitcoin's correlation with gold. It tells you, in numerical fact, that Bitcoin has not successfully transformed into the digital gold or the uncorrelated safe haven that so many narratives have promised. It is trading, day in and day out, as a high beta play on US technology stocks. So the real question you must ask is not what the Bitcoin halving cycle is doing, and it is not how many coins MicroStrategy just bought. It is this: is the capital flowing into the Nasdaq right now converging upward, or is it dispersing downward? The answer to that question is the answer to Bitcoin's next move. The same deep engine is driving both risk assets. Spigot of the US dollar. Last night, Jerome Powell's final FOMC meeting produced for dissenting votes and inserted language specifically noting that inflation continues to reflect energy prices. The market's translation was instant and brutal. Rate cuts in 2026 are now largely priced out, and the probability of a rate hike has crept above 10%. As long as that liquidity spigot remains tightened, risk assets are structurally capped. they will rise and fall together because the ocean they are swimming in is the same. Bitcoin additionally carries its own unique weight right now, the cost basis of short-term holders. According to Glassnode, the true market mean price for recent buyers is concentrated around $77,800. Above that level, there is a tremendous overhang of unrealized profit that is desperate to be realized. Below $76,000, a large cohort of holders is sitting underwater. This creates a mechanical pressure that repels price every single time it rises into the $77,000 to $78,000 band. That is the fundamental reason Bitcoin has failed to puncture and hold above $78,000 despite multiple attempts. Now, let me hand you 6 precisely calculated strategies designed to turn this resonance and the coming divergence into profit. Strategy 1 is the beginner approach for Bitcoin. Bitcoin is currently range-bound with a well-defined floor and a tested ceiling. You should not chase the price in the middle of the range. Wait for a retracement into the $1,500 area and initiate a light long position there. Set your stop loss strictly at $74,300. I want you to notice something important. I am not placing the stop right at the 75,000 round number. I am giving it a $300 buffer for wick hunting and liquidity sweeps. Risk on this trade must not exceed 1% of your total trading capital. Your profit target is $77,600. Why? Because this target sits just below the heavy short-term holder resistance, giving your order a high probability of being filled before the supply wall hits. Strategy 2. The intermediate Bitcoin trader uses an options butterfly to capitalize on the exact low volatility consolidation we are currently experiencing. Buy 1 put at $74,500, sell 2 puts at $75,500, and buy 1 put at $76,500. This is a put butterfly. The maximum profit occurs if Bitcoin settles right at $75,500 at expiration, precisely in the heart of the current support zone. The maximum loss is strictly confined to the small net debit paid. This structure profits from range-bound price action and is ideal for a market that is consolidating ahead of a catalyst. Strategy 3, the professional Bitcoin play, is a cross-asset pair trade against the equities that are most levered to Bitcoin's price. You can go long spot Bitcoin while simultaneously shorting an equal volatility-adjusted amount of MicroStrategy or Coinbase stock. These beta to Bitcoin. If Bitcoin rebounds modestly from current levels, these stocks may underperform the coin itself because broader equity sentiment remains fragile from the tech earnings rout. You are not betting on Bitcoin's absolute direction, you are betting that Bitcoin will outperform its equity proxies on a risk-adjusted basis. Set the combined stop at a level where the pair trade moves 3% beyond your entry spread. Strategy 4 is the beginner approach for the S&P 500. The broader market is showing fatigue in the Dow while the Nasdaq is being held up by selective megacap earnings. You can wait for the S&P 500 to pull back into the 7,045 to 7,075 zone, which represents a prior support shelf, and initiate a long position using the ES Mini Futures contract. Place your stop loss below 6,940. This gives you protection against a sudden earnings-driven gap. Your first profit target is 7,220 and your second is 7,280. Risk must remain capped at 1% of your account. Strategy 5, the intermediate equities trader, can sell a put on the Nasdaq 100 to collect premium against the elevated volatility backdrop. Sell an out-of-the-money put with a strike at 24,000, expiring in approximately 1 month. Your thesis is that, despite the twin pressures of war and hawkish rates, the megacap technology behemoths have the balance sheet firepower to prevent a catastrophic collapse below that level over the near term. However, you must hold enough cash reserves in your account. To meet any margin calls should the trade move against you. This is not a set-it-and-forget-it trade, it requires active monitoring. Strategy 6, the professional cross-asset strategy, is the core trade of this entire briefing. Bitcoin and the Nasdaq have been moving with a 0.6 to 0.8 correlation, but that relationship is not permanent. In a true extreme risk scenario, for example, a severe escalation in the Middle East, the Nasdaq may actually find a measure of relative support from domestic policy expectations, whereas Bitcoin, lacking a central backstop and trading 24 hours a day, could be the first asset thrown overboard in a liquidity panic. You can express this by going long the S&P 500 and simultaneously shorting Bitcoin, matched for volatility. This is a macro volatility compression trade. If risk assets come under a broad shock, you profit from Bitcoin falling harder and faster than equities. If the risk environment stabilizes and both rise, you lose the spread, but the short Bitcoin leg is then hedged by the long equity leg. Limit total risk to 2% of your portfolio now. Before you deploy a single dollar of capital, I need to sound the risk warning bell with absolute clarity. Number 1, the $75,000 floor in Bitcoin is real, but it is not armored. If this level breaks on heavy volume, price can cascade into the $73,000 handle and beyond because the liquidity underneath is dangerously thin. And number 2, canary in the coal mine. If the rest of the megacap earnings season disappoints, the Nasdaq will suffer a drawdown severe enough to drag the entire global risk appetite complex lower. Bitcoin will not be spared. Number 3, the Powell era is ending, and Kevin Warsh, his incoming successor, is historically one of the most vocal critics of prolonged quantitative easing in the Federal Reserve System. The market has not yet priced in the potential of a Warsh shock. His first public comments could reset the entire dollar and rates landscape overnight. Number 4, the US-Iran conflict remains a live powder keg. If the situation escalates into a full-spectrum blockade with active military engagement, the global energy supply chain will face an unprecedented shock. Global recession pricing will be absorbed into risk assets at a speed that will make today's moves look like a quiet Sunday afternoon. Here is the final summary. Bitcoin and US equities are no longer in a leader-follower game. They are two faces of the same liquidity ocean. Your profit opportunity lies not in mindlessly buying the dip or selling the rip, but in trading the moments when their ancient correlation strains, stretches, and eventually snaps. The trader who understands their synchronicity today will be the one who profits from their divergence tomorrow. Now I want you to do something for me. Look at that fear and greed index number 26. What is the first genuine emotion that forms number? Is it fear? Is it greed? Is it the cold, calm recognition of opportunity? Type that emotion into the comment section. Let's make this comment thread the market's honest, real-time sentiment thermometer. If you have made it all the way to this point in the briefing, you have already pushed yourself past 90% of the traders who stare at the price and never think deeper. Smash the like button to endorse hardcore, professional content. Subscribe and ring the notification